Let's get the conversation going with the management at Cello World. Yesterday, of course, Motilal Oswal had initiated coverage and we had seen a big spike in the stock price yesterday. Today, it's cooling off a bit. Gaurav Rathod, the Joint Managing Director, is joining us on the show. Gaurav, hi, good to be speaking with you. Of course, the last few months have been a bit muted and tepid of sorts, but going forward, what kind of growth rate do you have in mind? Which ends of the markets are looking up?
So I think consumer demand overall this year has been a little muted if you see across quarters, and overall though we've done decently well when you look at all the other FMCG companies and other companies. This year has been consumer demand has been slow, um, but I definitely see a recovery. I think after COVID you had two fantastic years where the growth rate was extremely high. So I guess this is just a cooling off which is happening this year. But it should all return back to normal. Though our growth has been double digit this year too. So I guess probably gained a little market share and also the product mix. We're launching newer products, and I think those are also helping the growth.
One of the brokerages coming out with a note believes that your company growth could actually be higher than the industry growth. Earlier, we were just having a brief chat on how recent things may be, kind of muted, but things are likely to improve. You think 25%, 23 to 25% visibility is there currently as you look into things because of the initiatives you're talking about next 2 to 3 years?
So I think our volume growth has been pretty good this year. It's almost 18 to 20%. Though the value growth has been slightly lower. That's because of a lot of deflationary pressures. When you look at raw material, energy prices have dropped quite a bit this year. So I guess that kind of numbers we should, and this is what our guidance has been also over the last few quarters, that those kind of numbers is what we are aiming at. We are adding a lot of capacity in our glassware units as well. And of course, the growth that we have historically had in all our other divisions, whether it's consumer wear or stationery, I think we hope to grow pretty robustly in the next few years.
Right, Gaurav. Good morning. This is Vinny joining in the conversation as well. You did pick up on a point of the raw material prices, but when I was reading your transcript for Q3, you were mentioning how this time the margins were impacted because of those raw material prices seeing a bit of an increase. Currently, what is the on-ground situation? And in the past, it's spoken about margins of around 23% or 25%. Is that something you would sustain going forward in FY25?
Yeah, so I think it was only the last quarter that we saw a little margin correction. But otherwise, if you look at the entire year, it's been, it's the raw material prices have dropped quite a bit. Though there was a slight increase after that in the last quarter. But overall, I think the margins is what we aim to maintain. We've been traditionally maintaining that over the years. And by adding new product lines, the product mix that we are constantly working on, and the innovations, we hope to maintain those kind of 24-25% margins.
Of maintaining 24-25% margins, but I was just going through the trends of your ROE and ROCEs. It's been coming off very sharply. I mean, from ROCEs of nearly 60%, it's now down to sub 40. Similar can be said for ROEs as well. I understand you're in a capacity expansion mode, but what is the level that becomes, let's say, the floor for you? What's the sustainable ROE and ROCE numbers we should expect?
I think over the years, about 25% plus to 30%. The effect that you see of the 60% is more of just restructuring. So those are not the right numbers. You will have to go by numbers what were published last year or in our DRHP. So I guess about 25% plus is we would definitely maintain, though we are in an expansionary phase. But even after that, the capital employed overall will remain pretty low.
Talking about the fact that while the volume growth was quite decent, the value growth was missing, and that's partly also on account of the competition. Talk to me about your consumer wear segment specifically. What kind of growth rates that you expect there, given the entire metrics of consumer demand on one hand, raw materials on the other, and the competition as well?
Right. So I think there we would want to be growing at about 18 to 20%, which we have traditionally grown. And by adding newer capacities, I think that will become a lot easier as well. So those are numbers that definitely in the consumer wear segment we aim to grow. Even this year, our profit, though our volume growth is 18 to 20% around, and our value growth has been lower, but our profits have grown by 23%. So I guess that has been the trade-off because of the cooling of the prices. I think that is the effect that you see. So I think in the consumer wear segment, we maintain that we'd be growing at about 18 to 20% year on year.
Okay, maintaining the target of 18 to 20% growth in the consumer wear segment. Thank you so much, Gaurav, for joining in with us this morning on ET Now, giving us an understanding in what we should be expecting from the company going forward as well, aiming to maintain the margins at 23 to 25% as well. That's the word coming from the management of Cello World.